Welcome back, traders. We're right back with Eric Hunsader. He's founder and CEO of Nanex. Also, Joe Saluzzi on the line on Benzinga's pre-market prep, brought to you by Charles Schwab, talking about high-frequency trading. Eric, you're really quick to point out all these mini flash crashes that seem to happen every day. What are your thoughts on why we see so many of those?
It's mostly it's market structure problems, where you've dispersed liquidity from one exchange, and only the top of the book is protected. So really, whatever's at the top of the book is what the liquidity is.
So what you're really talking about, some of these are actually what we would call trade-throughs, where the top of the book trades out, but then the order routes back to the original exchange it can actually trade through quotes of other exchanges if those quotes are not at the top of the book. Is that correct, Eric?
Yes, that's one main cause. The other cause is these momentum ignition algos that will detect a price movement in a stock, and then they'll just pile on, making them exacerbating whatever impact this a larger order had.
How many times do you see these things? Is this a daily occurrence? Do you see these flash crashes?
Yeah, dozens every day.
Wow. So, and what do we do? How do we fix it? How do we not have these things happen anymore?
Well, protected more than the top of the book would be one solution to the former type.
And isn't there sometimes liquidity issues too, where a lot of times I notice these things happen in the opening minute on some stocks, where you'll see a stock move very quickly in that opening few seconds, where liquidity really hasn't formed in the book yet. So it's more almost just a lack of liquidity sometimes, isn't it?
A lot of people don't realize that there is much less liquidity during the opening process than in the past, and unfortunately a lot of market on open orders from the retail guys who they've got a day job and can't time their orders as well, and they just come into the marketplace when there is no liquidity and hit a wide spread.
Joe, this is a point that you've brought up in the past, where you talk about high-frequency traders and talk about the liquidity they provide, but they seem to provide it only when there's other liquidity there. But in that opening few seconds, sometimes there isn't the liquidity there yet, and you don't see as much high-frequency liquidity at those times. Is that concerning to you, Joe?
Absolutely, and look at the intraday charts of many stocks where you see that either rip up or dump down in the first couple of minutes, and then it comes back the other way, and everyone's like, "What the heck just happened? It moved 50 cents." And you really have to be careful, particularly if you put in a market opening order, you are risking. It is difficult, okay, and you're pretty much relying on someone you have no idea of. There's no one to ask why the print went up there and so on. So I'd be extremely careful around the opening. In fact, we've got a couple of folks who tell us, particular names, particularly some of the smaller ones, they don't want to be on the opening. We're going to wait. Let's see how this thing play out. So yeah, that liquidity that used to be there, or that price discovery, let's just call it, is no longer there.
I'm sorry, Joe. I'm really surprised with all the order types offered to high-frequency traders that, the retail hasn't come up with a simple order type. I want to trade at the open, but 15 minutes into the open, for example. That would solve a lot of this.
15 minutes after the opening, or what is it? You want to
15
just
minutes.
Yeah.
Well, just a timed. I don't want
to bucket liquidity, right?
I want to be in the morning. I want to get in the morning, but I don't want the first second of the day.
Right, exactly. And for some reason, our business has always been 9:30. The horses come out of the gate, and at 4:00 they go in the barn, right? But at this point, there are other options out there. Some folks have talked about what they call batch auctions, where you're kind of bucketing liquidity throughout the day. You don't have that price discovery process that you used to. And there are, I think you're right, Derek, there needs to be some creative solutions to this.
Isn't it an issue just that we have now are almost too dependent on high-frequency traders for liquidity, that they've kind of pushed out all of our traditional market makers? We look at the NYSE floor, we don't see anything happening there from a human being perspective anymore. And so now that all the liquidity, or the majority of liquidity, is being provided by high-frequency traders, that isn't, and this liquidity we know vanishes when price isn't predictable, which is sometimes in those opening few minutes. Isn't it a problem that we need to incentivize other types of liquidity providers into this market?
Yeah, you've absolutely nailed it. What's happening here And what a lot of these high-frequency traders need to understand is in the end, due to economies of scale, there's only going to be one large high-frequency trader left. The best market is the one that has the most diversity of participants who have bringing different ideas and methodologies into buying and selling stocks. That gives you the resiliency to avoid herd-like lemming behavior that you're going to get when you get fewer and fewer participants.
So true. I mean, that is spot on right there. And that you want a diversity of participants. That's a good thing. A marketplace filled with the same type of buyers and sellers is not what you want. You want retail, you want growth guys, you want value guys, and that gives you that diversity. Yeah, and one thing that we're concerned about also when you talk about the high-frequency trading market makers is who are they? We know the big names of, the brokerage firms, but who are some of the high-frequency traders that we don't know? And particularly this week, there was a case that came out, a firm called Latour Trading, which is a division of Tower Research, and the SEC fined this firm $16 million for net excess for basically capital violations for 2 years, between 2010 and 2011. And it's very scary that the risk that these types of people are out there taking, and we all play in the same sandbox, right? We're all there. And if one guy is in that sandbox upsetting everything, well, we're all going to feel the effects of it. So we want to know, do the regulators have control of these high-frequency traders? Do they even know what's going on out there? And when you read cases like this Latour Trading case, it's very concerning.
And they do as much as 9% of the volume, I believe I read in that fine. Is that what it was 9%, wasn't it?
Yeah. Certain days the SEC said they were up to 9%. That's 9%. Okay, that's we're trading 6 billion shares on average today. That's about 600 million shares. That's a lot, and that's just equities, and you can imagine other products as well.
So we were talking a little about liquidity and these extreme price movements right off the bat with you there, Eric. The SEC has kind of put a bandaid in where we have these limit up, limit down circuit breaker systems. Is this circuit breaker system helping these extreme price oscillations?
The problem is that they never actually ran the limit up, limit down calculations on the day of the flash crash on that data set, and that is why they created limit up, limit down in the first place. And unfortunately, limit up, limit down probably needs some tweaking because the way the parameters are set, if it had been in place during May 6th, what we would have seen is large cap stocks, pretty much 25 out of the 30 Dow Jones stocks would have halted pretty close to the lows of the day, which is probably not something that you want to have happen because you're going to have more people be able to make bad decisions, if you will, on the flash crash. I mean, one of the saving graces of it is it came back so fast that it didn't suck in a lot of people into making bad decisions.
The issue with the flash crash more than anything was in a liquidity event, wasn't it? Because when I go back and I look at the books and I look at, and analyze the flash crash myself, I noticed some stocks that had almost zero liquidity, which seems unbelievable. And it kind of goes back to our point that maybe we have too many liquidity providers that are running the same programs and the same participants providing liquidity. Because when you look at a stock like Procter & Gamble that can go from $60 to $42 in a matter of seconds, or a stock like Accenture that can trade down to 1 penny a share. This stock was trading at $40 prior to the flash crash and traded all the way down to 1 penny a share. Why does all the liquidity just vanish like that?
Because there you have a wide group of participants who can't participate because they can't react and get and participate in that drop because it happens so quickly. They can't participate in buying it.
Joe, are the markets too fast? Is that the problem?
We would never say, I'm never going to say, hey, you got to slow things down, you have to regulate speed. But speed is, look, you can't stop technology. We understand that. But rules are rules. And Eric will tell you that there are rules that are not being followed and that we're concerned that some regulators don't have the capability to even spot the violations because of the technology that's being used on the other side is so sophisticated and so expensive that, look, the regulators can't keep up with it. So then maybe you do need to simplify some of these things in order to get everybody back on the same level playing field because right now there's no question about it. There are two different playing fields.
One thing about limit up, limit down I would like to say is, and this needs to be addressed immediately, is for a stock's IPO day, it really should be widened as probably double the width that it is now, as we do in the first 15 and last 30 minutes of the day. I mean, we had a stock, TKA Eye, earlier this week that halted 4 times on its IPO debut. And, with Alibaba coming up, that's something that we don't want to have happen. Investors shouldn't have to worry about not only the price, but what price can it be halted at.
Well, it's kind of impeding natural price discovery. I see this not only on the IPO, sometimes you see it on a news event too, where you have some small cap biotech firm comes out and the drug didn't hit results, and it falls, and then it hits the circuit breaker and has to halt for 5 minutes, and then it falls another 10%, hits a circuit breaker, halts for 5 minutes, falls another 10%. So it's kind of impeding that natural price discovery process. So I think I agree with you there, Eric. I think at a certain points on certain stocks that maybe they need to do some tweaking here, because when you see a stock on its IPO day halting 4 times, that doesn't help investor confidence, does it?
No, not at all. Especially the company who launched the IPO. Why is our stock halted here? Why can't it go higher? Because people want to pay more.
Dennis, there's a point where Eric's talking about something about the company. There's a missing constituent in this whole debate that we've been having, and that is the public company, the corporation whose stock is being listed on a particular exchange. You never hear from those folks. You never hear from them on their opinions of market structure or what they think of the fact that there's no longer a specialist and there's no longer a real market maker anymore. What do they think of a Nichols-White spread program? That's a problem, we think. There's a missing voice in this argument, and we would love to hear more from the public corporation to see what they think. And I've had many private discussions with them for different public CFOs and IR reps, and they don't really like this market structure, the one I've talked to. They're confused. They don't know what's under the hood of the car anymore, and that concerns them, especially when they get a flash crash type event in their stock and someone's knocking on their door at the IR office saying, what the heck just happened to our stock? And they're rolling their shoulders going, I don't know who to call anymore. There's no one there. There's a missing gap here, and if there's anything, we've tried to encourage them to get more into debate, and I hope they do.
Great point, Joe. When Knight Capital had that meltdown that morning, there were, I got a call from the CFO at a company where they had to sell that morning because that was their window of time, and they got 10% less for their shares than they would have if Knight hadn't melted down. And so when, the media was all boo-hoo about Knight Capital, they completely missed all the other victims that morning.
Hey,
Indeed.
Eric, I'm just going to finish this up, this segment of the interview, and I'm just going to ask you for your final advice for investors trying to navigate this HFT trading world. And then, Joe, we'd like your final advice as well. Eric?
I would ask your retail broker for an option to be able to route to what exchange you want, and make sure IEX is on that route.
Joe?
I think you have to stay involved in the debates, keep learning as much as you can, asking questions. It is extremely important that everyone knows what's under the hood of the car. You can't just take it for granted that you're paying $7.95 a trade and all is well. You got to ask questions, and it's your money. And if it's your money, you need to be involved. So keep asking questions.
Okay, great advice from Eric Hunsader, founder and CEO of Nanex. Also, Joe Saluzzi, who's been kind enough to take time out from his busy schedule to talk about HFT and market structure here on Benzinga's Pre-Market Prep, brought to you by Charles Schwab. We're going to take a quick break here, and then we are going to talk about the markets. Thanks, guys.
Thank you.
Joe, Dennis, Eric, talk to you soon.
Take care, Joe.
Take care, guys.